Hello and welcome to the Moving Market Podcast. I'm J.R. Gondeck and joined as always with David Sokolovsky. David, let's jump into notable market, recap of June and a little look ahead. I think for the most part, you continue to see that concentration risk of the markets playing out, but let's look at some of the numbers.
Sure. Thanks, Chair. In the month of June, again, the S&P was up 3% for the month, and that really continued to build on the gains from May. But the rest of the market, the mid cap, small cap, and international were all negative. So I think, as you kind of pointed out, tech is still very much in play. Semiconductors and some of the very largest names in the S&P 500 are really driving all of the return. I think when you dig a little bit deeper into the return from the S&P 500, it was really just a handful of names that drove that the entire return for the month of June. And when you look at it again, large really remains the best sector as far as the overall markets go. Year to date, as an example, mid is up 4%, small cap is up 1%, and it really highlights the difference between that and the S&P 500, which was up about 15% for the year. And if you compare that to the equal weighted index, again, the equal weighted is up about 4% on the year as well. So just a very, very large disparity and a continuation of the trend that we've seen earlier this year. A very interesting data point that I noticed was the emerging markets doing very well. And so as you kind of, again, dig a little bit deeper and see what's driving that, really one semiconductor name is really just representing 10% of the weight of the international index. It's not one that you would expect, so I encourage people to take a look. And it's really responsible for a significant portion of the total return of emerging markets. So again, once you peel back the tech, there's not a lot of activity going on. And then, one other area to note maybe is that value slightly underperformed growth for this month, so kind of reversing a trend from prior months. And bonds again, interest rates moving down slightly, but remaining negative on the year. So with that, I know it's a lot. It's a brief recap of some of the numbers, but once you look past the numbers and get into some of the why and what's going on, JR, do you want to talk a little bit about kind of the economy, where things are going and where we're seeing activity?
Well, the economy, David, we follow the Atlanta Fed fairly carefully over the last number of years, and when you look at the changes as data points come in, it just feels like this quarter has been much more volatile than quarters past. And I think it goes into the uncertainty of what we're seeing, overall, and kind of the separation of the market. Because one data point I thought was interesting from the second quarter stock market as well is short funds made 10 billion in the quarter, despite the fact that the stock market or the S&P was at an all-time high. And it just kind of plays into the fact of that uneven stock performance and economy. And when you look at the Atlanta Fed projections, we started the quarter off very strong, well over 4%. The April effect, we thought with the drop in the markets and the uncertainty, saw GDP forecasts come down below 2% and then rose back above 3%. And now as you look at recent data points, it's come back into the 2 range. So again, when you look at third quarter and beyond, is the economy going to hold this level, or is the trajectory heading lower? And again, this is going to influence where you should invest your money, what the Fed's going to do, despite inflation coming down and such. And it's just been a very uneven quarter.
Yeah, Jared, I think as you look at economic activity, that kind of goes hand in hand with the Federal Reserve. And I think this is an area we should probably spend a little bit of time on this month and really talk about, what's going on with the Fed, what the outlook is. One of the things that we've seen today was the inflation reading come out, and that's going to really drive the Fed's hand in terms of what the outlook looks like for rates. So do you want to spend a little bit of time talking about inflation, where it's been, and kind of how it's evolving?
Well, inflation's been much stickier than anybody expected the last couple of years, right? And there's a lot of reasons for, the pandemic support and everything else. But it seems to be we're going much back toward the 2% the Fed would like, maybe a little quicker than we thought 2 or 3 months ago. As you look at those CPI prints from January, February, March, which were 3/4. But then you look at May and June, and you have a 0 in May and a negative this past month. So looking forward and you kind of analyze the overall economy, it doesn't feel like there's a lot of pressures to expect inflation to jump back up in the months ahead. So it feels like the last 2 months trajectory is much more predictable. Now, the question the Fed faces overall is they're feeling better about inflation, but what about the economy? So the challenge, looking to rate cuts ahead, the Fed's likely to cut now in September, given the positive inflation data last month. But assuming that it's because the economy's in line and inflation's easing, that'll be a good thing. But this is the things we need to watch this month and beyond.
Yeah, Jen, one of the things that could unravel and one of the things that could, really drive the Fed to be more aggressive with the rate cuts would be the labor picture, right? And as we know, the U.S. economy is primarily consumer driven. Really, 2/3 of the economic activity is driven by the consumer. And as you look at the labor force, you've seen that despite the fact that we've had some very strong headline numbers, the revisions have been negative. So if you look at the last couple months, the initial reading from last month was 272,000 jobs. That was revised lower by 50,000 jobs. The prior month, was revised lower by 50,000 jobs. And so you're seeing the continued revisions downwards. You haven't really seen much on the way up, but that could drive, some softening in the labor market. And if you look at another measure, which is not necessarily the, initial reading and then the revisions, but the unemployment rate, you've seen this over the past 2 years, kind of, the first year really between June. So same as this time a couple years ago, June of 22 to June of 23, really not much changed. Unemployment hovered somewhere in the 3.6, going as low as maybe 3.4, but hovering in kind of 3.6, 3.5 range. But what you've seen over the last year, and this is something the Fed has tried to do with raising interest rates, is to slowly cool the labor market. And you've seen that have success, but another way to say it is unemployment has ticked up. So you're seeing unemployment slowly moving higher and higher. And if this trend continues over the course of the next several months, the Fed may be more aggressive with the rate cuts. And at that point, they're essentially cutting for, what we would consider to be not a good reason.
And when you look at the rate cuts, David, of what's forecasted, like I said earlier, September is now likely for the first rate cut. And the projection is probably one more rate cut between September and the end of the year. Now, the question is, what does that mean for your portfolio and where do you allocate? Because the challenge has been the last 6 months and really the last year and a half has been the momentum relative to large cap growth. Will lower rates offer a rebalancing opportunity? We have to see. Today's one data point where you see a big movement out of growth into everything else, because in theory, lower interest rates will help smaller mid-sized companies much more than large. And there's just a relative value, because when you look at where the markets are, your peak valuations and peak exuberance, you can argue on what's worked, which is namely, the large cap growth. So there's good reason to believe that could continue. On the other hand, I think you got to be mindful of keeping a balance between, what's working and then what changes could be ahead. And this is an important month from the standpoint, second quarter earnings, which in general we expect to be fairly solid, but it's going to be the outlook. Does your valuation justify what you see ahead, right? And that's what the markets are going to be looking for. Whereas, like I said earlier, shorts made a lot of money in the second quarter. There's a lot of opportunity in the breadth of the market. There are a lot of companies lower, and as their outlooks maybe improve, a lower interest rate environment, there could be some opportunity overall.
Sure. So looking at where the opportunity is, and what the performance has looked like, we've seen a lot of headlines. I think the S&P has made 37 record closes this year. So if you think about where we are in the year, it's more than one per week on average. And if you kind of flip back the calendar and look backwards a little bit, in 2022 you had a large slowdown, primarily in growth, right? If you look at those double-digit numbers, and this is a graph we've looked at in the past. So you've had 33% decline in large growth. These are the exciting tech names of today. You've had, large declines in mid cap, small cap, and international growth. And in 2023, you saw that strong rebound. So far this year, again, all of the action, has really been in the large cap growth component. But if you look towards the value side of things, you didn't have a significant drop. you then had a stronger recovery in 2023. And in many cases, really across every category, they're positive and outperforming their growth counterparts. So do you see then, as you kind of mentioned, as the rotation takes place from growth to everything else, that value will continue to benefit and continue to outperform on a longer term basis?
Well, and that's the $1 million question, David, right? And this is why you need to look at what happens with earnings this quarter. What are the outlooks? And again, how's the economy and what are interest rate projections with the Fed? Because the likelihood, if the base case is the economy slows down, but we don't head for a recession and inflation eases and the Fed normalizes rates, you could easily see a bigger rotation into everything else in the months and quarters ahead. So I think now more than ever, it's important. The strategy of the last 6 months or so has been maybe to lean in toward growth of what's worked. Now I think when you're at peak valuations and all the exuberance around what has worked, be mindful of watching for the opportunities to take profit and keep that balance overall. But looking ahead, there's a lot to look at this month, and with that, we'll be able to kind of update where we should go in August and beyond. So that one, thank you for tuning in, and touch base next month.
Thanks.